Two investors start on the very same day with the exact same $10,000. Jake spends every single weekend researching companies, reading earnings reports, hunting for the next great stock before anyone else finds it. Emma buys one boring index fund, sets up an automatic transfer, and then, basically, never looks at it again. 20 years later, Emma has quietly beaten Jake, and she has also beaten most of the professionals who do this for a living. And the reason is not luck. It is brutal, simple math that almost nobody explains. Because everyone assumes the way you win in the market is by picking the right companies. Find the next big winner early, and you get rich. It feels obvious. It feels like effort should be rewarded. But the actual data points almost violently in the other direction, and once you see why, you cannot unsee it. Meet Jake, the stock picker, and Emma, the index investor. Same $10,000, same 20 years, same market, doing the exact same thing for both of them. Watch what each of their strategies actually did. Start with what Emma quietly owns. An index fund is not one bet. It is a tiny slice of hundreds, sometimes thousands, of companies all at once. When Emma buys it, she is not trying to guess the one winner. She owns the entire market in a single click. Instant diversification, almost no effort, and a fee so small it is practically a rounding error. Now, Jake. And to be fair, Jake has something Emma does not. In any given year, Jake can absolutely beat the market. Pick the right company at the right moment, and a single stock can double. Or do far better than that. That dream, the home run, is exactly what keeps Jake researching every weekend while Emma is out living her life. But here is the first piece of brutal math. The market's entire gain comes from a tiny handful of enormous winners. The vast majority of individual stocks actually underperform, and a shocking number of them go nowhere or quietly die. So if you are picking individual stocks, your real job is not just to find good companies. It is to not miss the few rockets while dodging the hundreds of duds. Emma, by owning everything, captures every single rocket automatically, without having to guess. Researchers have studied this for decades, and the pattern is almost absurd. A small slice of companies create nearly all of the market's long-term wealth, while the rest, taken together, barely beat a savings account. Picking stocks means trying to find that needle, on purpose, over and over, for 30 years. Owning the index means you simply keep the whole haystack, needle included. And here is the second piece, the one that should stop you cold. The professionals, the people with research teams, terminals, and decades of training, mostly fail to beat the index too. Over any 15-year stretch, something like 90% of professional fund managers underperform a simple index fund. Let that sink in. If the experts, with every advantage, lose to the boring index 9 times out of 10, the odds of the weekend researcher beating it long-term are not good. Then come the quiet killers, fees, and taxes. Jake trades often, so he pays trading costs, and he pays higher taxes on his frequent short-term gains. Emma barely trades at all, so she pays almost nothing, and her gains compound untouched for decades. It sounds small, a percent here, a percent there. Over 20 years, that small leak quietly drains a fortune out of Jake's account and leaves it sitting in Emma's. And then there is the part no spreadsheet captures: behavior. Jake watches his stocks every day, so he panics when they drop and chases them when they spike. He buys high on excitement and sells low on fear, again and again. Emma does not watch, so she does not flinch. When the market crashes, she keeps buying on autopilot. In investing, your temperament beats your intelligence almost every time, and Emma's whole strategy is built to protect her from herself. You have probably watched a Jake do this in real life. He buys the hot stock everyone is talking about, right near the top. It drops, he holds in hope. It drops more, and he finally sells in disgust. And of course, that is the week it turns around. Multiply that one painful cycle across 20 years, and you basically have Jake's entire return story. Quick, honest note before the numbers. None of this is financial advice, it is just what the long-term data tends to show. Your situation is your own. Now, back to it, because here is where the gap between these two actually lands. Put it together over 20 years. Emma's $10,000, plus steady contributions, riding the whole market at roughly 10% a year, quietly compounds into a genuinely large number. Jake, even with a couple of real winners, gets dragged back down by his losers, his fees, his taxes, and his bad timing. More often than not, after all that effort, Jake ends up behind the woman who did almost nothing. The harder he tried, the more ways he found to lose. Now, to be completely fair, this does not mean individual stocks are evil. If you genuinely enjoy it, keeping a small slice of money, the part you can afford to lose, for picking a few stocks is totally fine. The mistake is betting the core of your future on it. For the money that actually has to be there in 30 years, the boring index wins, and it is not even close. And here is the trap that fools almost everyone. In a roaring bull market, picking stocks feels easy, and Jake feels like a genius. But a rising market lifts almost everything, so he confuses a good market for a good skill. The test is not whether you can win in a great year. It is whether you can win over decades, through the crashes, and that is exactly where the picker quietly falls behind. So, the real reframe is this. The index fund is not the boring consolation prize for people who are not smart enough to pick winners. It is closer to a cheat code. You get the full return of the entire market for almost no effort, almost no cost, and almost no chance of blowing yourself up. Emma did not settle. She quietly chose the strategy that the math was always going to reward. And maybe the most underrated part is what Emma got back that has nothing to do with money. Every weekend, Jake spent staring at charts. Emma simply spent living. She traded the illusion of control for actual freedom, and the math rewarded her for it anyway. The best strategy is often the one quiet enough to let you forget it even exists. So before you spend another weekend hunting for the perfect stock, ask whether you are actually beating the simple index. Honestly, after fees. Tell me in the comments. Just type the word index if this changed how you see it. And if you want the next breakdown, the one on exactly how to start investing the simple way, it is waiting for you right now. I read every single one.